The United States had got downgraded by Moody's rating agency on the May 16th, 2025. It is a very big moment for the United States, not in a good sense, but in a very bad sense. Yeah, the United States debt got already degraded by the other two major rating agencies, S&P Global in 2011 and the Fitch ratings in 2023. Yeah, before the first one was the S&P Global. So there were some kind of reasons that led the S&P to downgrade the United States debt, because the United States debt is considered as the world's most safest asset. Yeah, there's even a term labeled for it, which is the American exceptionalism. So the S&P did back then was because of the political reasons on the fiscal management and the other stuff. But in 2023, when the Fitch did that, it was the debt ceiling crisis. Yeah, if you don't know about a debt ceiling, it's the psychological limit that the administration identify of the national debt. That if the national debt surpasses this limit, there are some fiscal concerns now. So in the history, a lot of times the United States expanded its debt ceiling limit to take on more debt. So now the Moody's are also downgraded the debt of the United States from the label of AAA to the AA plus. So right now, all of the three major rating agencies has downgraded the United States debt. So what are the concerns for the United States now? The investors, the other parties involved in this American financial system. So let's talk about this. Yeah, I will be talking about whether the United States debt will be seen as a riskier asset now or not. But before that, there are some numerical points I need to highlight from the Moody's report. Yeah, it says that the federal deficit to the GDP ratio from 2024, which is 6.4%, but in the 2035, it will be 9%. Yeah. And the national debt to GDP ratio will grow over this period from 98% to 134%. And the interest payments will go from 18% to 30%. Yeah, I highlighted these points to give you more uh, behind the scenes understanding and background working of the Moody's report about downgrading the American debt. But why this downgrade? Yeah, this is a very historic moment because right now all of the three credit rating agencies, as I said before, is giving a negative outlook about the United States debt. But the question is here that how it will affect the markets. From my analysis, I think that effects will be more contained. There will not be the bigger fluctuations in the markets and the volatility in the treasury markets, because when the first time the S&P downgraded at that in 2011, there was a bit of a panic in the markets because it was the first time. It was the first time that this thing has ever happened. So the investors got panicked, and but after that, the investors and the other players in this financial system broadened their definition of the safest debt and the American exceptionalism. They broadened their definition that if American debt is not the safest debt in the world, then which else is? So they got used to this thing, and when in 2023 the Fitch did the same, there was not much. There was a modest reaction, and yeah, right now it's almost a week, I think. The stocks did not tumult very much, and on the other hand, U.S. Treasuries The longer US treasuries, the 20-year or 20 years, 10 years, and the 30 years, those treasuries are having a higher interest rates, and they are ticking up. Yeah, they are ticking up, and the interest rate curve is getting steeper. But this trend was already there before the Moody's dropped our port. So there will not be much of a very panic reaction over the long run. But yeah, the condition right now about the American debt ceiling and the stuff is really concerning for the investors also. But there's another point which I noticed is that before the 2011 downgrade, most of the contracts on between the investors, between the banks, between the financial institutions was specifically stated that the debt which is being traded must contain the triple A rating by the biggest rating agencies. So yeah, now when the S&P did the downgrade, there was a much of a panic because of the legal contractual obligations. We those contracts between the in the Wall Street stated. After that, the most of the contracts were rewritten, and they excluded the term triple A credit rating, but to and they included that the American back debt. And if I talk about the investor's perspective, then I can say that the investors got lazy. Yeah, investors got lazy in rating their debt. Yeah, because they outsource these responsibilities to these credit rating agencies, and on the other hand, these credit rating agencies only factor in the specific factors. Yeah, they have specific criteria to rate a debt. But on the other hand, investors are of the different types. Some investors' motives matches with these credit rating agencies, but some other investors are not clearly in the same page on the same page with these credit rating agencies. So they have to factor in some additional factors in rating the debt. These credit rating agencies just rate the American debt on a surface level, on a broader level, but the investors of the different type, they can be banks, they can be traders, they can be the institutions and corporations from different sectors. So they need to rate this debt in a different way. So this is the pattern I recognized, but yeah, it is a very easy way, and as I said, that the investors got lazy. It is a very easy way to trade that debt between themselves. Yeah, because if a majority and a community is relying on a specific credit rating agencies to rate a debt, then it is easy for them between them to trade the same debt and for the money for the goods, so they can circulate the same debt between themselves easily without worrying much. So yeah, the it provides a greater liquidity in the US Treasury markets, and yeah, the US Treasury markets is one of the biggest liquid markets in the world and the deepest one. So, so it is a very big perk for the investors also. Another analysis of mine says that investors are not holding American debt for the purpose of the investment. Yeah, I'm saying this because it is very clear that investors are trading the United States dollar in return for the United States treasuries. So, because a lot of investors are very easy to, and it is very convenient for them to hold the US Treasuries instead of United States dollar, because the United States dollar does not pay any interest payments, and also United States Treasuries are easy to trade, and it is easy for the global trade also to trade between the trading partners. So it is better to hold the United States debt instead of the United States dollar, because obviously it eliminates the effect of the inflation from the money, from their money. So investors are holding, I think, primarily because of this perk instead of an investment. So they must not get bothered by any downgrade now. And yeah, because of this perk, it is somewhat clear that the United States will not ever pay its debt back to the investors, because it is the machine, it is the grease of the global financial system. Yeah, obviously, as I said, because it is considered as the most safest asset in the world, and the investors are primarily holding this debt for the trading purposes. I think so. It is very convenient and viable for the America to issue more and more debt to the system to keep its reserve status, as I explained this phenomena in a previous video. As so because of these perks, United States will not pay back its debt, I think, ever. But if it pays back, it can easily issue the dollars, print the dollars, because the debt is its home currency. It's in the United States dollar, not in the home currency of the other country, which gives the money to the United States. So it is easy for them to just print the dollars and pay back to the to the creditor country. It will be just beneficial for the United States at the end. But for a typical investor, it will be just beneficial for the investor, in the sense that instead of holding the United States dollar, it can hold US treasuries to get some real return over the inflation rate, and it can offset the effects of the inflation from their money. So this was my analysis about this matter, and I hope you understood my points. And if you like this video, then don't forget to show some support. Bye.